Good morning,
Morning,
everybody. Oh, Piotr, you're going. I'm going. Morning,
Yes.
everybody. So we are back again for our Sunday spectacular. We are, of course, missing the legend that is Mr. Ross Harper. He is doing far more interesting things with far more interesting people. But we don't take offence. We don't take any ill will to that. We will make him feel guilty for it, though. That's part of the fun. But no less are we joined by Mr. Adam Lawrence. We'll be going through the cliff notes of his Super Sunday spectacular review of the week. We have the lovely and angelic Helen Chorley, who has been discussing mushrooms, pineapples, and sharks. Not to be missed. We've got Mr. Ruzinek up in the corner here. Everybody knows him. Everybody loves Piotr. Definitely more than they love me. So let's get this kicked off. We are going to be talking. I thought we'd probably start off by saying, what do we normally do? Like, what's our Christmas plans? Because that's something that everyone's kind of talking about and thinking about. There's been a lot of news around Omicron and the BBC in their traditional way, in the same way every media is traditional, have been kind of hinting at potentially locking stuff down before cases get out of order in February and March, that kind of thing. So what are people putting in place? What was the pre-COVID plans for a standard Christmas? And what does Christmas look like this year? Who wants to kick that off? Adam looks primed and ready, in fairness. He's got to start building up his 84.7% occupation time on the call. So
you start me off on this sort of subject. It's very dangerous on the soapbox style event, but we're all legalities and restrictions willing. We're going to see my brother and do what we should have done last Christmas, really, and have a bit more of a broader family Christmas together. So that's the plan. It obviously falls on the way it falls on the weekend is quite handy, I think. But I do like that run up to Christmas for just leaving a few people with a few offers to think about of stuff that's in the pipeline. It's been successful over the years, so I'm hopeful there'll be a little bit of fruit there as well. But we managed to nick a couple of bits after auction again last week. So although December's been relatively hot, I think probably better sales percentages than I would normally have expected. There do seem to be a few, it's that rule I think we mentioned last week, that if you come into market at this time of year in an auction, you're motivated. You're really, really genuinely motivated. So done a couple of post deals that are below the guide, which is nice because they looked okay deals at the guide, but maybe a little bit tricky. And that's bread and butter stuff, isn't it, gents? You know that. So that's amazing. That's New Year. Nothing planned. Can't plan to really go out anywhere meaningful. Can't plan to go abroad. I don't think. I just don't think you can. Which is, I just, in terms of mentality wise, I'm just battle hardened, shut us down. Similar mentality that got us through. It's funny to think it was only less than 12 months ago that we had the January, February this year was bloody miserable, wasn't it? I mean, let's face it. A lot of work got done, so that the one positive I'll take out of that. But it's just I'm not speculating on the end of the pandemic, especially at this point. Some people might have called it already over. Some people might say we've got another 2 years to go or whatever. I don't know. I'm not really thinking about it because I'm going to stick with that old mantra. I'm worried about what I can control, and I'm not worriing about what I can't control. And it's as simple as that.
I think it's difficult to predict like the end of pandemic and all this kind of stuff because now there's a lot of companies that and people who've got interest in keeping the pandemic going. Almost it's like almost economically. So some people it just not be positive, and it just depends who's saying what, and now it's all kind of fear based. So
it's the biggest bit of business is climate change, isn't it? But let's not go there.
I mean, I went into London on Friday, and I stayed over till Saturday. And I was walking down the Finchley Road because I was staying not far from there, and there was a whole parade of shops years ago that had completely burnt down. The upper parts completely burnt down. It was closed for ages, and one unit has basically been unoccupied for about 4 or 5 years, which is ridiculous considering where it is.
It is, yeah.
And now there is a lateral flow kind of PCR. Back to work, travel, same day, hour. It's kind of like back in the day when you used to get your passport photos taken, like, oh, you come back in an hour, that kind of. It's exactly that. And that is just one minute element of how this kind of because I'm of the opinion that COVID is just going to be another flu cold thing, right? People are saying, oh, it's over, it's going to be another 2 years. No, it's there. It's going to keep evolving. It's going to keep changing in the same way that every year you need another flu jab because the flu's evolved or changed, and they don't really talk about it, but it's the natural kind of growth thing. And I think it needs to, like anything, needs to be respected, but it can't just be used as a scaremongering fear tool or tactic used to kind of subdue people. That's where it becomes something that's just not tenable.
What's your plan for the Christmas time, Helen?
So
what's happening on the investing front?
Yeah, looks pretty similar to last year. I'm out here in Malta with my parents. Last year, I don't know, I had like my spidey senses were going off last year, so I managed to get them out here just before lockdown 2. So I had them here for 5 months. Oh my God, give me a knighthood now. Last year, and they came out there. They've just come out a couple of weeks ago, hence we're all still locked down. Last day of quarantine. Woohoo! I've managed not to kill them, so that in itself is a result, and they have managed not to kill me, which is probably even more impressive. So they're out here for for Christmas, for New Year, and then we'll see how long. But this year has been unseasonably cold and stormy and rainy, so to be honest, quarantine hasn't been too much of a hindrance, because I don't know what we'd have done otherwise. Last year was glorious. Friend was on about coming over here and made the decision to go to Tenerife instead. Good choice. So,
That's where my sister is going on Thursday.
Lovely. You've got to be coming up to almost 20% of the year in quarantine, Helen.
It's 57 days.
57 days. So you're
not that you've counted.
Yeah.
8 hours, 14 minutes, and 30 seconds.
Oh yeah.
I've been following some kind of, it's not really news, just some undercurrent kind of stuff. So I've traditionally between Christmas and New Year's Eve, I don't look at the market at all, like the property market. I treat that as kind of, I literally hibernate. That's like the 6 or 7 days where you get to just reset. But this year, as opposed to the last almost 20 years, I've now set up postcode alerts in areas that I know that I'm hungry to be buying in on Rightmove, because I am of the opinion that Boxing Day, if not New Year's Eve, there is going to be a biblical flood of properties entering the market. I could be completely wrong, and I'm absolutely prepared to be completely wrong. But I literally, I think it was Thursday, I set up postcode alerts for 6 areas, like specific, like the first 3-4 characters of the postcode. And I've just gone any asset type, anything that comes up, anything that's listed Boxing Day, there's motivation there. And I it may be
you think that's motivation, or is that an overworked agent who didn't manage to post it before Christmas?
Well, from my days in estate agency, which I promise you wasn't that long, it was sub 2 years. I really couldn't stand it. I used to work throughout that Christmas patch. Basically, obviously, Christmas Eve you would be working till mid-afternoon. Christmas Day would be off, but Boxing Day and the 2 or 3 days afterwards, the admin people in the office would be going absolutely mental with just writing down all the instructions, because there's no point putting on 3 or 4 days before Christmas because no one's paying attention.
Well, even in the 2 weeks before, I'd argue probably, to be honest,
because every man worth their salt hasn't bought a single bloody Christmas present, and Christmas Eve and the 2 or 3 days beforehand, I'm really slamming the male race down here, but are going down Oxford Street or wherever they're going. It used to be Brent Cross for me. Used to be going around panic buying presents for 30, 40 people like an absolute lunatic. So, they're not looking at properties. God knows what women were up to, but I imagine most were either getting ready for Christmas or having to deal with kids or going and cooking or do whatever, or working or whatever the story was. You'd just be cracking on. So your main market of teenagers over 18, right, where you can actually buy, all the way over to 65 were occupied doing other stuff than actively buying property, with the exception of like diehard property people. So the majority of agents would just be like starting to run down the stock that they have. Even letting starts to die down a little bit now. And then it wouldn't be literally that Boxing Day when you've had enough of your family. You know, you've done Christmas Eve, you've done Christmas Day. You now have got the post-Christmas blues, right? You're 4 stone heavier than you were before, and you're thinking, right, what can I do? Well, you go on Rightmove, and every agency worth their salt knows you at 6:30 in the morning, 7:30 in the morning, you hit the market, just hit it hard. And I never really worked in a major city agency. I worked in Rickmansworth and a couple of other places, but you know, that's the time to be looking, you know, because by the Monday after Christmas, you could be registered to view 6 or 7 properties that day. And you could be there viewing them before, you know, because most people between Christmas and New Year start thinking, right, what's my New Year's resolutions? They start, then they start planning. Oh, we're going to have a child. Are we going to buy a house? Are we going to do this? Are we going to do that? And you need to be knocking on the doors and rumbling through the cupboards and checking the water pressure on the shower upstairs before they even know the property's on the market. You know, so I could be wrong, but I'm being rather aggressive this year as a complete change to every other year.
I think it's this is the time of the year where the hard work pays off more than any other in my view, and it's just that psychologically. I think we touched on it last week, but the country needs a rest, and it's now facing theoretical lockdowns and whatever else we think might go on before Christmas, which is continuing the mental assault that most people have had to deal with over the last couple of years. They're going to be tired. They're going to feel like they deserve a rest. It scuppered them all going off to Dubai like they sometimes do, unfortunately, because of the travel restrictions. But still, I think there's a lot of people who are going to need that downtime. And if there's a lot of people away, you know how the market works. So I think it's probably a great battle plan, Jay, to be honest with you. I wish I could say I normally don't do that every year, but I'd be lying.
I'm playing catch up, which is normal when I'm talking to you, Adam. So
it's good though, because the days the week things fall on as well. That Monday and Tuesday won't really be operable days either, so it's compressed that little week of activity. Yeah. It's quite a compressed Christmas holiday. At our commercial site in the East Mids, the Derbyshire schools aren't finishing until the 23rd of December, which has shafted us from a what you're going to do with the kids before Christmas perspective, which is not ideal. But they've got the week after the New Year where they're still on school holiday when most are back. So it's an interesting decision. But these little local anomalies also can play a bit of a part, can't they? It's like, you know, when you try and go to the supermarket at the optimum time, so there's not 50 million people there. Maybe it's just me, but I've tried 1 o'clock in the morning. I've tried 4 o'clock in the morning. I've tried 5, and it just varies gigantically year on year, depending on where Christmas Day and Boxing Day fall. It's quite difficult to predict, but it's anytime the market's difficult to predict and funny things are going on, it's a time that I welcome with open arms, Mr. Howard, just as you do. So
absolutely.
I'm still trying the supermarket experiment in Malta. They're quite mad over here. They get up and do things like where I go to exercise. They have classes at like 5 and 6 o'clock in the morning because the Maltese are up early. So I've been trying to work out with the supermarket, obviously not the past 2 weeks, but when to go. Oh my God, I still haven't worked out. Literally, I'm going to have to do a spreadsheet on this. I'll report back next week.
I used to go shopping as a single man. I used to go shopping, not to go shopping, but to pick up girls. So I used to, like, on a Friday night I'd be at Asda at like 2 o'clock in the morning in the produce section looking lost. And then some very friendly girls would normally take pity on me. I used to end up in student digs quite a lot as in my very early 20s. But I mean, and there was just to get on point here, there was a lot of data analysis that went into kind of divining when the prime opportunity to take advantage of that was. I was terrible in clubs. because I've got no rhythm. I can't dance, but I like to sing to all of the songs. So I just do a two-step and sing really loudly, and I look like an absolute lunatic. So pubs and clubs were never good, but it was always very good. Like in the same thing with picking up post-auction deals, picking up girls on the way back to the digs at 2 o'clock in the morning. You get some real bargains at that time of morning in Asda.
I'm not sure why they call you the auction insider or when they call you the opportunist, really, if I'm honest with you. Being as charitable as I can, yeah. Listen, mate, whatever gives you an edge, right? That's the bottom line. That's what it boils down to. That's it. When I've been watching games of Lithuanian basketball many years ago when I used to trade a lot of arbitrage bets, whatever gives you an edge. Whatever gives you an edge.
Nice one. And Helen, you had a really good post this week about investors and mushrooms and how.
I did. Somebody rattled my cage again. Doesn't take much. No, there's one particular person who's not kind of doing right by people at the moment again. And so was helping somebody out, kind of pointing them in the right direction of how to go about things and the steps to take in order to kind of recover some money. And also I think actually when people have loaned money and it's not coming back, and communication has completely ceased from whoever has borrowed that money, I think that leaves a lot of investors just very uncertain. And sometimes they are right to be very concerned, but in this case, actually, as we talked him through it, we were able to point out what security is in place and what he's got, and that actually it's a matter of when the money comes back, not if. So that was quite a nice conversation. Lovely chap, very grounded. I think I was angrier about the situation than he was, bless him. But yeah, prompted me to do a chat about being in mushrooms and how sometimes, and this is it's very small minority. We all know lots of great developers out there, but how some developers like to treat investors like mushrooms, feed them shit and keep them in the dark, and just not good enough in my book, just not acceptable. So rant of the week. Then.
We had a dinner on Friday night with our buyers club. It's just kind of like, we try and do a social thing every once in a while, and we had a couple of guests join us, just one or two. And one of the ladies in the club was like, "Oh, I'm fed up with dealing with tradespeople and construction stuff like this. So, who would go into development?" So I got on my high horse and I was like, "Yeah, development. Who would get on development? Yeah." And then they were like, someone on the table got a little bit obviously offended by what I had said. I said, "Well, okay, well, look, let's take a sample of 100 buy-to-let investors who are building a portfolio, who are, compliant and paying their taxes and doing things straightforward. Now let's take 100 developers. Yeah, let's put them side by side, two nice little cultures, and let's review the same number of people in 5 years' time. In 5 years' time, you are likely to have 60 of those developers still in business, or maybe I'm being too harsh, but you're likely to still have that 100. Maybe they're not buying anymore because maybe they've got their £4,000 a month residual income that they're looking for, but they are still going to be there. They're not going to be bankrupt. They're most likely not going to have people banging down their door. Development, and you have to understand risk profile again, right? We discussed this till the cows come home. It is the riskier side of real estate investment. You are more likely to go broke and bust and lose other people's money or lose your own, or as a construction person, working with a developer, you're likely to go bust if unit prices go up in terms of workers or in terms of in terms of materials. Everything is so, whereas you can really balls it up. You can overpay for an asset being a buy-to-let investor. But if you're never selling the bloody thing and it's covering the mortgage, it's leaving you a little bit over the top, you're going to survive.
Yeah.
You're going to survive. If you're stoic enough, if you wait the 20 years, it will wipe its face or whatever it is. If you remortgage and don't keep topping up, you'll cover your back end. But
the thing is, it's a bit like, isn't it? The trouble is, the more mercurial the develop, and it's like anything in life, the salespeople get the action. The best product doesn't necessarily sell all of the units. The iPhone, for example, is a bit of it's a unicorn, isn't it? Realistically, there's lots of best products out there that never make it to market, that never make any meaningful money. And in development, it's just easier to be so highly leveraged that you can be in the deal for 5 or 10%. It's quite hard in buy to let to do that. It's really in this day and age, because apart from anything else, the first charge lenders try their best to put a stop to it. So you have to really go with a significant workaround. Whereas in development, it's accepted, because the first charge lender's on sort of 60%, if that, and then the rest of it, they're like, well, hey ho. I remember speaking to a business local to myself has just brought out another bridging company, and the bridging company was run by a really interesting individual who'd made a lot of money from sell cash for gold shops after the financial crisis, sort of 8-figure net worth. Really interesting character. Couldn't hold his attention for more. We had a meeting with him. It lasted 75 minutes, and he said, "That's the longest meeting I've had for 5 years." He said, "That's a big compliment. Normally I'm just bored and I tell people to sling their hook, And during that meeting, he was pitching his sort of joint venture development funding, which at the time was really taking off. It hasn't really. This is a few years ago now. It was actually around about that sort of Christmas, New Year time when you only get to speak to people like that. We went into his office. There was no one else in there. We kind of had all the time in the world, sort of thing. And he said, well, we've done a few of these sort of JV development deals, a bit like the way the Go Develop model works and stuff like that. And I was like, all right, how have they gone? And he said, well, we've had to repossess every single one of them so far. And we've given people, it's not like we haven't pulled the trigger quickly. We've given them 12 months to do this, another 6 months to do this, whatever. And we've ended up having to get someone in to build it out. But we've got so much coverage, it hasn't really been an issue. And I was like, well, it has been an issue for the people borrowing the money and the people who funded the people borrowing the money. And that just sort of tells you what you need to know to an extent. And the other thing, you do have to be a bit sharper on a development loan anyway, because it's easier for value to be destroyed. Half-finished empty buildings are a problem. And after 12 months, they're a much bigger problem than they are after 3 months now. So, it really is time to take speedy action. When I see stuff that's been swiped that's on bridging loans that's, buy to let or quirky, it's usually quirky stuff that's maybe SA or something like that. They've given them years of rope to try and sort it out before they've pulled the trigger. Whereas it's more like months of rope, really. And then, there's the button, guys, realistically. And that's something I think a lot of people don't realise. And if you can raise 90+% of the capital from other people, of course it's dangerous, because your 10% is going to become 30% or going to become minus 20% with sometimes relatively equal need. And if the best talkers get the money, then there's always going to be that problem, isn't there? And there's a lot of people who don't put the time into becoming financially sophisticated enough, which I think is still the number one mistake that I see people make. They just sort of think numbers are for the accountant, and it's like, can't do that. Not allowed to do that as a developer. Not allowed to, And you just see people not really understand what they're getting themselves into. And I mean, obviously this year has absolutely kicked people in terms of sensitivity analysis and stuff like that, because anything sensible would be looking at 10% on materials, for example, and it just hasn't touched the site. It's just so fortunate that GDVs have lifted. Otherwise, if we went into a scenario next year where there's still material pipeline supply chain issues in the first half of the year, and GDVs did stutter, the market does stutter. I'm not saying that I think that's a relatively low probability scenario, but I think it's very likely it won't keep going at the rate it has been going. I think that's nearly nailed on. So the spread starts to tighten a bit. Whereas if you said, get the Selco catalogue today, get it in 6 months' time, compare the two, we'd get some seriously different answers right now, wouldn't we?
Yeah, exactly. We had a lady actually on Property Elevator. I can't remember which episode it was, this last series. She came in and she'd done her numbers, and it's the only person that I've ever seen. Obviously, I asked about contingency, one of my favorite pet questions. She'd allowed 20% contingency.
good.
I've never seen anybody put in 20% contingency, and even I was like, oh, more for the fact that it was 20%, like, you know, that everybody usually uses 5, which is, frankly, in my book, never enough. And you know, I'm always saying at least 10, and she put 20 in, and I was like, do you know what? That's bloody clever in this environment with what's happening. And actually, we filmed it in the summer. So she even had better foresight, or she was even more conservative than me, maybe. But to have 20% in there, great move. Great move.
If your deal still stacks with a 20% contingency,
Exactly what I was going to say.
That's unbelievable, because your worst case scenario is the 20% is swallowed, right?
Yeah.
Armageddon happens, 20%'s gone, but everyone's still happy because it was accounted for. Worst case scenario. The best case scenario is that you use 10% of the contingency, then you have 10% BAMF or bump or whatever you want to call it, that either goes to yourself or to the investors, and everyone is also still happy. Like, but that's insane. I mean, I know a developer that used to do 12.5%. I don't know how we got to the figure of 12.5%, because I know some people do the 5% contingency, and that would make me sweat in uncomfortable places.
Yeah, I mean, as you'd expect, with that much, you know, buffer in there, it made the headline figures, so your return on investment and your return on capital employed, it made that look a lot less attractive. But actually, then it's a judgment call of, actually, have you, or you know, is it almost like a paper exercise? Have you just transferred some of that? And there's also a hope game, and you can't play hope, and I'm not encouraging people to play hope game, but have you transferred some of that expected return into your contingency, such that if the whole contingency isn't in, you know, a bit of that can be effectively moved over to you know, and that's, we're into, you know, a lot of kind of speculation there, but you're right. It doesn't make the deal overall look as attractive.
Well, it would be interesting to see if there was a scale of, if I've got 20% contingency, if I lower the contingency to 10%, does the bottom line figures rise? Because then you can actually see what parts are movable.
Yeah,
that would be very interesting.
You look at it, you know, it comes down to the phenomenon of expected value, doesn't it? One of my favourite subjects in the whole of the world. But if you're looking at a 20% contingency, you can start putting a much higher probability on hitting those return figures, and if your investors understand that, it's extreme. Which, of course, Helen would understand very easily. It gives you a lot of power if that's who you're pitching to, you know. And this is I remember I've had some ridiculous conversations over the year. I remember speaking to a friend of mine who's got a very healthy SAS pension. He lends money out on it. He's done pretty well on it over the years, but he lent to someone who I thought was 50-50, let's say. And I was like, how did that loan go with X? You know, and he said, struggled to get my money back, overran by 18 months, this, that, got it back in the end, had to compromise on the interest because I would have had to, you know, I'd have had to pull the plug on him otherwise. And he's got a family, and, you know, he's a nice guy, this guy. He's not a brutal lender. And I said, what was he, you know, and he said, he was paying you 1% a month or whatever. And I said, the trouble is I've got funding at sub 1% a month, so I haven't really got room for, I'd love to do something together, but I'm not just going to pay you because you're a nice guy ultimately, and that's what it boils down to. And he said, well, you know, the thing is, X paid me 1% a month. And I said, well, A, he didn't, because he had to take a bath on it, and B, would you rather lend it to me where you know you're going to get it back and I've got coverage to pay you back, or would you rather lend it to because I know someone who'll give you 2% a month, and he's a fat guy who drives Bentleys that he's leased, and he lives in a mansion for £1 or whatever he's up to these days. You know, there's no point comparing unicorn fake pretenders / thieves, quite frankly, is there?
Yeah.
It's your favourite line: return of the capital before return on the capital. And that's what people really need to be thinking about. Would you have a much more certain, i.e. you are going to get your money back and you are going to get the interest or the return paid of, I don't know, you know, a few percent less? Or would you rather have a more speculative, well, you might get it, you might not, you're not sure, you don't know what this person's doing, but they're going to pay you 5% more. Like that premium for taking that additional risk that the capital doesn't come back, in my book, and we all know I'm quite risk averse, has to be effing huge.
That's right. That's right.
I was just thinking, because I love it when Adam goes on a little bit of a rant, because it's always a magical time for me. But I just had a flashback to, we were invited to a rather lovely dinner at the Houses of Parliament. This was pre-COVID. And we're having a lovely dinner, and there's I won't give the names of the people at the table.
I would say I remember it well, but that might be misrepresenting the amount of alcohol that was consumed at that dinner, Jake.
There were phenomenal amounts of alcohol at that dinner. But what I will say is sadly, with most things in my life, I remember it exceptionally well. And there was a rant that took place. There was an argument between Mr. Lawrence here and a rather well-known, in inverted commas, developer. And the question came up about, it was the definition of, and you'll know this, the definition of arbitrage and what it means in property. And it was absolutely beautiful. It was kind of like, it was perfect. We were in between courses. There was a mid-meal wine being passed around the table, and Adam completely picked this person to pieces. It was absolute. And then someone else who is also, it's a rather savvy table anyway, a very, very tall, broad, short-shouldered person around the table was like, no, seriously, Adam's right. You've really got the wrong end of the stick here. And the whole table just went completely silent for a minute. Another course got put down, and then no one mentioned arbitrage for the rest of the meal. It was. I still refer to that as like one of the. It kind of like when you're studying law, you have to do like you do like mock trials, you do moots and things like that. And this was kind of, it just kind of felt like one of those moments where someone was on the other side and had completely argued the point perfectly, and the other person was just completely staggered and befuddled. Like, I didn't know how to progress. The ego was trying to push it forward, and Adam was like, "No, but you're wrong."
I would pay good money to see that.
I take no pleasure in saying that circumstances since that dinner have kind of proven my version of events and not his.
Yes,
sadly, but
and yeah, brutally accurate, sadly, but yes, yeah.
There's a couple of really good comments, and I thought there's a prize for you, Adam, for the word, using the word mercurial. And I guess we can play a game. If anyone of the audience has got a word that you would like us to use, we'll post it, and we'll find a way to use it. Probably Jay will.
Good stuff. Yeah, Vicky made a good comment there. Doesn't everyone use three scenarios? Best case, worst case. Yeah, I think realistic worst case is probably what I look at as the one thing to as the anchor point really in anything that we're doing. And I suppose Vicky's mentioned BRR there. If you're talking BRR, there are a few little things you can do that sometimes, because everyone is susceptible to a bad valuation. Everyone is, we have our bits that we do. We avoid certain surveying firms like the plague if lenders are using them. And I know we're not the only ones, from talking to the brokers, from talking to the BDMs. I know there's quite a few who think the way we do. We do a couple of other little things. And sometimes it just means another 3 months before the money comes back out. So you need to be making sure you're not too, that's not your only payback route if you're using investor money, for example, and we've done it before. We've had, vals 20% below another valuation 3 months later. And we've tended to wait, because if we've had it before where the same person's gone out and valued it 20 grand lower than they valued it last time, even though nothing's changed. There's so much variance in a valuation. People don't, everybody always wants to pick on someone for losing it. We've got an investor that we're building a portfolio for at the moment, and he wants his number on LTV. He's come in, he's sold a business, he's in a great position. He wants to have about a 60% loan to value long term, limited company portfolio. It's family investment company. It's going to spread down through the generations, right? Lovely plan. And I made the argument to him and said, look, I think you still want to be looking, depending on the pricing of the debt, on some of these at 75% LTV. And I'll tell you why. One, because certain numbers of them, especially if we're chasing the lowest rates, will down value it about 10% anyway. So there's an argument we're down at 65 already. And because this is going to take a number of years to do it properly, instead of us just going out with a shotgun and just maybe buying some good, some bad, and some average deals, and some ugly ones as well, no doubt. Then instead of that, by the time we're getting into year 4 and year 5, and we're getting towards completion here, then your old mortgages are now going to be at the 60% level or below. So let's look at it as a across the board stream of things, right? We're not going to then go back for because a lot of people also, I think, forget in BRR. You've got those stages that, depending on how many R's you put behind it, but all of it is about almost the one thing it's not the one thing I don't like about it, because there's certain people in the industry who use that acronym who I don't like very much at all. But let's just set that aside for a moment. Is that the R, however many R's you put in, the final R is still relatively short-term thinking over a long-term investment. And if you go back to what Jay said earlier about there's your 100 buy-to-let landlords and where are they in 5 years' time? Well, you know what? In 5 years' time, you need to refinance. So let's start on the what if. I've seen people be so addicted really to BRR. They'll be like, well, I had to get an 85% mortgage on that one to get my money out. And it's just like, okay, we need to have a little chat about what's going to happen in the medium term here, because, our asset management strategy involves at year 5 or sometimes shorter, potentially moving over to a bigger portfolio style loan, which will have different LTV requirements, which will have different rates, different terms, looks a lot more like a commercial loan. You need to be quite cautious with these things, but like anything, you balance your risk out and you choose on that stuff. You also, I think, choose your lenders as wisely as possible as well. But the final R is not the end of the journey. It should be called BRRRRRRRRAM, I reckon, because the AM should stand for asset management, and people forget that it's not the end of the road. And if they're not, we were having a conversation this week. There was a Christmas get together, a few local landlords, and this guy was saying about he's paying 4% interest on his HMO mortgages. All this stuff, and it's fairly clear his financial strategy was just not really there at all. And he sounded like he didn't present his assets and liabilities in front of us. It wasn't that sort of dinner, but you could see, or I could see, there was massively unrealized potential in the portfolio he'd already got, because his financing strategy was dross, really. And there was also unnecessary risk in there. I mean, it became very clear, and people forget. It is on the buy-to-let side, you can often be very asset rich. Cash flow might not reflect anything like the amount of paper equity you've got, but you've still got the responsibility of managing that 1, 2, 5, 10 million pound. I've seen some people with 15 million pound portfolios who don't have a clear financial strategy at all, and it just means you've got to work harder, and you're going to give more money away at the end. And that's before you get to the tax planning side of it, which I went on a full rant about. You'll be pleased to hear, Jay.
Yes.
But again, it's about not absolving your responsibilities in that department, and unfortunately people sometimes do. And it's kind of, look, it comes with, if you're going to run any business, right, I'm rubbish at sales and marketing, right? But there's sales and marketing involved in my trading businesses, right? There's sales and marketing involved in my investment businesses, right? There has to be. So if you don't know what the hat is, you're still doing it without any tactical or strategic plan whatsoever. And that's going to blow up in your face at some point. Or the very worst, it's going to mean you work twice as hard for half the money you could have made. And that's just, at this time of year, any time of year, a fundamentally stupid thing to do, let's face it.
So I find stuff like this fascinating, because I was investing pre-2010. 2006, 2007, you could get 110% mortgage, right? Obviously, stuff like that isn't happening now, and there's been a lot of kind of changes around that. But you see a lot of stuff posted on social media and property investors, blah 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 blah, and people almost don't feel like they've got a good deal unless they've managed to pull all of their money out. I pulled all my money out. It's cash flowing. In fact, it's given me 30 grand off the bank. Blah blah blah. Not every deal has to you don't have to flood or drown every single deal in debt for it to be a good deal. It doesn't need to be like that. What is wrong with leaving equity in the deal? And people are, but I need to go again. Okay, we'll go again. You now have an asset. You can leverage. You can you can do all these things. You've got
You
an
can borrow
experience
against some of that equity you've created and left in. Yeah,
easily,
absolutely.
and
Absolutely.
it's I'm so scared for people on that point.
Exactly. And this is why we do this every Sunday and why we talk about risk so much, because that is a fundamental misunderstanding or misappreciation of risk.
Yeah.
You prioritized something you've been told by a trading company, get your money out, get your money out, get all your money out, to take unnecessary risk. Like,
Where do we sign, Helen? Where do we sign? Where's the back of the room?
But it's also like this. A lot of people take these 2-year kind of mortgages. There's nothing wrong with a 2-year mortgage. But at the end of 2 years, if the market's been upright like it's been for the last 2-3 years, they're going to have increased values, which means they'll go, oh, maybe I'll take an extra 20 or 30 grand out. Because they're like, oh, I can reinvest that. Well, what about the existing asset that's been treating you well for the last 2 years? Maybe take 10 out, go on that cruise you wanted to do. I don't know. But, don't there's no point drowning the entire asset. Because
mate, there's no point loading up on debt to fund a lifestyle. That's the other side of that, isn't it? Ultimately,
let's circle back round to developers that go bust.
And conversations about arbitrage in the House of Lords. Yeah, absolutely. Yeah.
Exactly. But I mean, let's go back to Vicky's comment about worst case, best case, and reality, which is most likely you're gonna meet in the middle with most things that happen, right? And essentially, that's what's going to end up happening with BRRRR, however many R's you fancy. The chances of your debt stack is you're going to have equity, then you're going to have first charge lender. That's pretty much it. You go over to developer, you've got your slice of equity, you've got private investor equity, you've got traditional debt, you've got development debt, mezz. Before you get to it, you've got 17 different types of people with an interest in an asset.
Yeah.
And a development, any development can go Pete Tong very, very quickly.
Yeah.
The person go on.
One of the biggies, and this year that has been a huge biggie, is not even, even if we set aside the material issues, it's the time issues. And time is the greatest punisher of. I had a friend of mine who's got a big development company who said he came back. He'd been out to Hong Kong to do a couple. He used to work out in China for years, and he'd been out to Hong Kong. He said, "I met this great guy over there who's in private equity. Who explained to me about the IRR of this, that, and the other, and whether this was a good deal and whether this was a bad deal." And I said, "A, I'm a bit pissed off because you could have had that conversation with me, right? But B, the trouble is what you've just described is how to analyze the deals that you've already done, not the deals that you're going to do in the future. And how did you? And what's the common thread between these? Right, took him a little while. And he was like, well, those took more time. Yeah, exactly. That's why your IRRs got hammered, right? Now, how could you have predicted? Where was the spread? What were your thoughts on how much time that might take? Well, we couldn't foresee that, and we couldn't foresee. It was like, well, A, maybe you could, and you need to go and rethink some of that. But B, on that basis, it's all very well knowing how to count it. But if you're going to go into indeterminate length situations, I mean, I remember seeing, I won't mention her name, although the very fact that I've identified her gender might possibly be a bit of a red flag. But I watched a presentation several years ago with someone we all know very well, used to run a property meeting. And it was let's say it was run under a banner that I don't necessarily respect very much. They tend to wear stripy shirts and I rate them relatively lowly. But this individual person is very, very solid, very intelligent, very accomplished, no BS in her. And at her meet, she had the aforementioned, I've already said mercurial once. So with the aforementioned, the siren, possibly the we'll call her the investment banker. We'll call her the investment, even if that's not the right thing to call her, or maybe it is if you like rhyming slang. But she gave this presentation and she went through this deal, and there were 4 stages of planning involved. Right, there was a 4-stage. I've never seen it before, and because it wasn't a huge deal. There were 4 stages of planning involved. And I looked around at the room, and they were kind of, well, siren is a good word, because it was like they were under a spell. Right now, I'm more disagreeable these days than I've ever been, but I still probably wouldn't go to someone else's property meeting and stand up and say, this is an utter bloodbath waiting to happen. But that's all I could think in my brain. I was just thinking, you can't be making money. Your investors can't make money from this. And at the end of the meeting, and then of course, even someone as cocksure as me, at the end of the meeting, I was watching everybody else's reactions and thinking, have I got this wrong then? Am I wrong? Am I the one who's wrong here? Because everyone else is like signing up and getting into newsletters and want to work out how to be brilliant on social media and all the rest of it. And I was just thinking, there's a train crash coming in. Someone needs to change the points, But people just don't put that stuff. I don't even know. I didn't even look at the pitch and how that was actually framed as it would ever make anybody any meaningful money. I think the approach was to say something like, we'll make a 40% profit on this deal. And I remember thinking, you won't, but if you do, it'll take you 8 years. 8.
Yes.
Right. So
well, I mean, the number 8 is fortuitous in this situation, right? It's an easy 8. But the reality is, you shake the 8 ball and just see yes, no, maybe, all right, or try again later, right? That's what happens. But the reality is, you see it a lot. Like a lot of people, I'm on a Facebook group where it's like, oh, they find deals and stuff like this, and they present the deals on the Facebook group. It's mainly piss. The 95% of it is absolute tosh. And you look at some of the deals they're presenting, and they go, oh, okay, so the return on investment is this, the return on capital employed is this, but they don't do it all on the same deal, right? So what they do is they pick the metric that shows the deal in the brightest light possible.
Of course.
It's absolute
sales and marketing, my friend. Sales and marketing.
Absolute piss. The lot of it is like, and you're just sitting there thinking, well, okay, yeah, of course, the yield looks great, but actually, what is the net return? What's the net? And you type net twice, and people haven't got a bloody clue what you're talking about.
We've been negotiating on a very small portfolio this week, and not only is it small in number, but it's also small units. It's like 1-bed flats and stuff like that. And the thing is, we've been able to agree terms on most of it, but there's a flat in, I think it's in the south of Scotland somewhere. This one flat. So portfolio spans Scotland and England. And the guy can't understand why we can't be at the same level for an area where you just need a big disc. You've got very dim view of capital growth. You've got quite a dim view of the socio-economic nature of the area. And then he's got one flat in an area which is one of my buying areas, and it's kind of like, well, we can definitely do a deal on that one. But he said, you're miles off on this one. And it's like, well, how can I explain to you that, over here I'm, 52p in the pound, but over there I'm 73p in the pound, and also the Scottish extra stamp duty and all the rest of it doesn't help when you're going over the 40Ks, because it's another 1%, and it's that Dave Brailsford mentality, 1%, 1%, 1%. It's what makes all from a yield basis. If you start off with whilst gross yield's a pretty naff metric, if you start off with a 1% higher gross yield in a deal, then what that's going to do to you by the time you get to the end, based on the financial structure, based on the security of the cash flows, based on everything else, it's that sort of. I know a lot of people have taken the view, and obviously people's views have changed over the last 5 years because London has underperformed apart from anything else. But 5 years ago, you used to get people. I would go to London, give a presentation, and people they want to come over at the end and sort of pat me on the head and go, oh, bless him, he's investing in the Midlands, and then in those 5 years, I've utterly destroyed what they've done, from so many different angles. And it's kind of like, I'm not the sort of person who says I told you so, but if you invite me back to that meeting, I probably will. Probably will.
Love it.
Brilliant.
It's gonna make. I love an IRR calculation. I think Rod did one on the tooting deal that we had done, and I almost went blind looking at that IRR. I was like, what? And he posted the analysis on, I think it was UK Property Traders, and there must have been about 200 or 300 comments on that post, and I'd say a third of them were asking, what does IRR mean?
Yeah, yeah.
And he didn't explain it once. I mean, in a show of unbelievable kind of patience was. He explained it like several times.
Yeah.
It was like
I think he cut and pasted the same comment. A whole
he
number
did,
of
yeah.
times,
Just
didn't he?
kept going. But it was kind of like 3,000 and something percent
It was-
IRR, which is like blow
it
your
was-
pants off good, right?
It was big. It was big. It was one of those where comment number 301 was probably Ross saying, "I sold this before I bought it the other day. Therefore, is my IRR infinity or something like that." But, yeah, it was an epic, and it just shows, the power of being able to do deals. And as Rod always says himself as well, there's blending your point about there's nothing wrong with leaving a bit of money in the deal. That's why I say to people, they go like, it must be 25% below. I'm like, 24.9% below. Here I am, high, buy all of them. And it's an arbitrary number. It's not the right way to look at it. But in the same way, there's no point getting 4,000% IRR on a fiver, which I know with that deal you guys weren't. You were talking about a very nice chunk of change. But there is a point where percentages get a bit pointless when it's like, I left 63 quid in this one at 150%. Okay, can you get any more 150% for me anyway?
I mean, exactly. But like the same comment I made earlier on, if you were to judge that deal based on the yield, it was a mediocre deal. Like it was 7 and a bit percent, or just about 7%. It was fine. It was never. You're never gonna like write a story about it. It's yeah. Sorry, Helen.
And that's the power of understanding the numbers. The question I get asked all the time, Adam, is like, what's your, target return on GDV? Some people will go the next point and ask, what's your return on cost? And I'm like, well, there are kind of like vague numbers, but that, yes, I love numbers. That doesn't tell me all, as per what we've just been talking about. Who's the person? What's the time frame? How realistic is that? What's the risk? Am I going to actually get my money back? Like, you can't just go on, oh well, look, it's 20, 25%, it ticks your box. There's so many more boxes than that, I'm afraid.
It's what I was talking to a property sourcer recently, which it doesn't normally happen. But this person was like bang sure that they could find me a deal, and I'm like, you can't. I've never met a deal sourcer that can perform. And maybe it's because I'm too picky, or maybe because they just don't understand their arseholes from their elbows. I don't know what it is, but there's a metric that I'm not taking into consideration. Like, okay, so I said, well, I'm looking for some excuse. And he goes, okay, so what kind of pound per square foot would you buy on? I said, okay, so what's the asset? He goes, oh, I can't tell you the asset until I know what you look. I said, well, look, if it's industrial, it's this. If this close to a town centre, it's that. If it's A1, or like, obviously everything's changed. If it's tertiary, it's this. If it's secondary, it's that. If it's primary, it's this. If it's high street, it's that. There isn't a single solitary price point metric that I'm going to tell you I will buy on that, because you are doomed to failure if you haven't got metrics that move with the quality and the class of the asset that you're looking to buy. It's insanity. Like if someone goes, oh, I buy on a 10% yield in CV1 and an 8% yield in CV3, I'm going to believe them. Yeah, you're probably right. That metric is going to change from postcode X to postcode Y if you're buying the same, like for like 2-3 bedroom house or whatever it is that you're buying. But for the love of money, some things, it drives me absolutely insane. How can I answer that question? Could you answer that question, Adam?
But the people who are asking the question don't understand the answer anyway. That's the fundamental problem. But I'm gonna stand up just for the last few minutes. Definitely stand up for sources, because I noticed that this week someone posted they've joined a trade body, if you like, of sources, which I think is a good step forward. I think Tina Walsh is behind it, which is good because she's written some good stuff on the subject. So that has to be seen as a positive step forward. Much as I would say Cyril's property training accreditation it has to be a step forward. So fair play for taking that on. And look, I've found some good stuff, but unfortunately, I've loads of conversations with sources because I still feel they're my best out in terms of leverage. The very best deals they've bought me. And you can't treat that. I moved the wholesalers and the sourcers to two different boxes, but focus on the sourcers who say I'm badged as a sourcer. I've had some great deals through them. I mean, we got the Genesis Centre through a sourcer ultimately, but actually it was through an agent, but still someone who brought it to us for a fee. And of course, commercial sites, it works differently. But I've had quite a few good deals where the sourcer hasn't necessarily understood the magnitude of what they're presenting, I suppose. And that's your problem. It's the needle in the haystack. It's the 95% of it is utter. Even some of the sharkiest names in our industry who have lists of deals that they pump out on a weekly basis, there'll be one or two a year that are absolute knockers. And they're knockers because they don't know that they're good. Now, you've got to decide whether A, you've got the analytical skills, B, you've got the patience, C, there isn't a better use for your time, etc., etc. But there is patience. Sometimes the Genesis site was brought to us as here's a great development opportunity. They hadn't done the barest bit of due diligence. Not a good development opportunity at all. Fantastic asset management opportunity. Aha. Well, now we're talking. So, and exactly like you were saying about your deal with the mega IRR, exactly that presented in one way. And that's when the auction sometimes does you a big favour, isn't it? Because the catalogue says X, people are in a relative hurry. They're cognitively lazy. If COVID has proven one thing, bloody hell are people cognitively lazy. But you see, I don't even read the blurb most. The only time I read the blurb is to understand what other people might be thinking. Because I'm never forming my opinion from the blurb. That's ridiculous. But that's when they do you it's a bit like the old agents, cash buyers only. I can't remember the last time I bought a cash buyers only house with cash. I don't know if I've ever done it, to be honest, But please keep using those phrases. Keep them educated to the level which they're educated, because that ultimately is the whole trade.
No, absolutely. I mean, the reason
different types of sources, right? So, there's sources who are kind of trained and trained by some whatever £5, £10, £100,000 trainings, and there's sources who actually are commercial agents, or they actually act on property transactions forever, and they know what's they charge a fee. However, they charge a fee based on it's quite a professional process. It's not a starter type job in a property. It's actually a professional service that they provide. So they're two different types of services.
And this is why I'm having conversations with them.
Yeah, their fees are usually good value, to be honest. They're usually fair. You don't look at them and begrudge paying them, or certainly I don't.
Yeah.
Well, I mean, this is one of the reasons why I'm talking to them, because I want to, there's a lot of stuff that's already out there that, I can do, all the stuff through the auctions. But we're always looking at multiple avenues to kind of get stock through the door, right? Or to get the stock to do some due diligence on. And it's probably me just having really bad luck. I've just not had any luck with any sources. So if there are any sources listening, they can actually present a deal.
Don't go to Jay, come to me. That's
it. Go to Adam, because he's clearly having far more success. You're going to get more fees through Adam than you are going to have through having a chat with me. But I think that's the problem.
I've kissed a lot of frogs, Jay, if it makes you feel any better. A lot of frogs.
I kissed a lot of princes. That's my problem. I didn't even take the chance. I just thought, damn it, let's give us a snog.
Nice
there
one.
Was a good comment there, Piotr, just before we finish, from Sim about low guide prices spreading. Yeah. What do you guys think about that one?
You're seeing it in with auctioneers that traditionally hadn't really done that in the past. So in that respect, I agree with Sim.
Will it blow itself up, do you think? Is that the inevitable end? If we do have a tornado of this, will it stop working?
Well, I mean, there was some rather impressive sales statistics in the last couple of weeks for auctions, but they're still only counting it on lots offered and sold, not from the lots that they started with, because from the lots that they started with, their sales success rate is below 70%. So it's not, and if they were confident enough to stick it in their catalogue, then that's basically them. That's an invitation to treat, right? Basic contract law, invitation to treat, consideration. It's now mine, right? And that's the situation. That's the beauty of auctions. So for them to remove that entire metric, and it's an important one, as we've been discussing metrics or matrices, which way you want to go. For them to skip that out is a little bit egregious, actually.
Well, we did a bit of kind of we're tracking some numbers for one of the auctioneers that kind of publishes the guide prices and then the results and kind of a nice table way which we can copy and paste into a Google sheet. And basically they are kind of for the last couple of years they've been posting really low guide prices, and we stopped even like looking at most of the properties because we know it's like we'll have to be fighting over those properties with a lot of people, and likelihood of getting those properties anywhere close to the guide price is ridiculously low. And so we tracked the guide prices and then compared this with the sale price, and we got like a difference for each property. And literally there is like 70%, 100%, 250%, 300%. Those are not unusual numbers for those properties, like for most of them. And literally there's one that sold for minus 16% below the guide price, but that was like a freehold ground rent for 25k. But a lot of other properties, literally nothing is anywhere close to 10%. It's yeah, or there's one at 10%, which was a vacant flat. The guy did 130, sold for 142, but that's an exceptional property in that auction.
Same as you, really, just given up on. I mean, Sim said he's given up on looking at certain auction houses' catalogue. I don't know what other weapons we have in the locker apart from, joining the queue of the people that are the insiders at those auction houses. Really, I just don't know how to transact with them.
It's difficult. It's and I guess all those prices are all driven by sellers' willingness to sell. But sometimes those sellers, a lot of the properties are from the same seller or the same group of companies, and they kind of like create their own market. They create their own rules and the auction house kind of just accepts things because it's the biggest client. It's a massive.
No, I appreciate that. Yeah, they've got limited amount they can do about it because they need the business. Yeah.
If you've got more
caveat emptor, right, Jay? While we're on contract law, caveat emptor needs
caveat emptor. Yeah, people keep telling me it no longer exists, but you can. I think you're in trouble if you take that opinion. I think if you're a stock provider and you're putting more than a quarter of the catalog together, like in 2015, 2016, there was a client that was providing maybe 30 or 40 lots into the catalog. If they take those lots elsewhere, that's a damaging thing. So you kind of have to pay the piper. You have to pay the piper. The buyer has to pay the piper. The only person that doesn't pay the piper is the person with the power, and the power is magnitude of lots, right? It's a game.
And Vicky says that some of those auction houses are brilliant for selling, though. I think more brilliant for selling is literally the actual strategy of like committing to a low reserve price, and then lots of people fight over it. So it's not a new thing. It's not a kind of auction house specific thing, but some auction houses do take it to extreme.
I think as well. I've definitely discussed strategy on lots that we've released before, and in my mind, there's definitely a too low price to set because people will. And some of that is Scotland is different because there's a lot less trust in the auction market. When we've released stuff, it's kind of like, do you know what? If you start this too low, you're not going to achieve what it can achieve. So there's definitely a too low as well as a too high in my view. But those guys as well, Piotr, Jay, they'll just whip stuff at the last minute if it's not being bid up to where they want to, or they'll say, "Oh, the vendors accepted a private." They'll use all the tricks in the book. So if you're not, it depends how you're willing to play the game, doesn't it? I'd rather play it straight up and meritocratically, let's say. But some people prefer alternative methods.
That's right. Well, brilliant. It's 11:11. Sounds like a numerically very significant time and good time to finish, possibly. I think we've got some really good comments today, and if you guys have some topics you want us to discuss, throw it in the comments, and share the video, like the video, subscribe, whatever you're watching, whatever you're doing, and it's great chatting. Anything else to add in our penultimate chat
No,
this
just
year?
thanks to everyone for their contributions today. Like you said, really, really good stuff. So it's great to have an interactive audience.
Yeah,
Does
Nice
that
one.
mean we have to wear Christmas jumpers next week?
Christmas jumpers. Oh, that would be difficult.
You can just have a bit of tinsel around your ear or something like that. We'll let you off. We'll let you off with that.
Okay, I think we'll find something. Nice
Good
one,
stuff.
guys.
Look forward to it.
Cheers,
See you
all.
soon, everyone.
Thanks, everyone.
Good day.
All the best.